Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. The second quarter earnings season is upon us in the US, coming off the back of a first quarter that certainly provided the basis for a strong run-up in US equities. And the bull market still continues apace with the likes of the Nasdaq and the S&P 500 both pushing into record highs as we lead into this first major week. Now, as is typically the case, we see a big focus on the banks with the likes of Wells Fargo, Citigroup, JP Morgan reporting on Thursday the 11th and Friday the 12th. And then things really kickstart the week after that. So I wanted to take you through a whole host of charts from FactSet. They are essentially the primary provider of this kind of data, really drilling down into some of the key elements to watch out for, some of the key elements that we have seen from Q1, what we're looking forward to for Q2, which sectors look particularly interesting, which areas are expected to underperform. A whole host of data to get through, and then I'll take you through a few charts for some of the key names that will be reporting over those first 2 days, the 11th and the 12th of July. So let's get into it. First and foremost, we should take a look at the big picture. Now, this is why we're seeing equity markets in a bullish trajectory. And ultimately, when you look at different markets and say, you know, someone might be bullish euro dollar or someone might be bullish gold, you always need a justification for that. And certainly this is the justification for the S&P 500 to be this consistent performer. And that is that essentially earnings continue to rise, earnings per share, and earnings per share on a forward basis, so expected earnings per share also rise. So of course, that increases the value of the stocks and therefore the equity market should rise. Now, we have seen equities move in significantly higher recently, and you can see that disparity between that change in the forward 12-month earnings per share and the price of the S&P 500. We've seen a gap growing there. But by and large, as long as we see strong growth in terms of earnings per share, the outlook for further strong growth going forward, then it justifies further upside for equity markets. So the S&P 500 uptrend is supported by the uptrend in earnings per share. That can be driven by improved earnings. It can also be driven by deterioration in the number of shares, so buybacks and the like. So those are the key elements to be looking out for over the course of this earnings season that could justify higher prices for the S&P 500. As we can see here, the forward 12-month price to earnings ratio shows that we're relatively lofty when it comes to the valuations. That means that either we need to see the earnings per share of these companies improve to justify it, or equity markets need to fall, or equity markets can continue to rise. But then we get into the areas where people say, you know, is it justified? And we're really in a sort of frothy area at the moment. But at the moment, we're certainly elevated by historical standards. But, you know, we're not at absolute extreme peaks. And so there's still justification for further upside over and above the gains that could be driven by improved earnings per share. Now, I just wanted to quickly switch over to the chart for the S&P 500. And this is just to highlight exactly how things played out last time around. So this is the first quarter of last year. Essentially, things kicking off with the big banks here on the 12th of April, and then rounding things up by and large with NVIDIA's earnings at the back end of May. And you can see here that we actually saw plenty of volatility. Now, what came into it? We saw a protracted period of upside, and then we started to see things falter a little bit. And once we started to see the earnings coming in, we saw some question marks emerging over the following weeks. And then things started to improve. And certainly after we saw the tech names all reporting, which is earlier, but with NVIDIA wrapping things up, we saw a bit of a pause, and then we ultimately powered onwards and upwards. So as you can see here, you can see a very clear uptrend in play, but the earnings season has the potential to throw a spanner in the works. Now, bear in mind, we also had an earnings season back here as well. The period of time that we don't have earnings season always seems very short. Of course, I'm doing these videos on a weekly basis, so that break in between doing the videos never seems to last particularly long before you're back into looking into what's to come. And on this occasion, we're again around about a week away from kicking off that Q2 earnings season. What we have seen since the end of Q1 has been more upside, and we've been pushing into record highs for the S&P 500. But the caveat here is, are we going to see another pullback around earnings season? Well, look, it comes down to the data, right? And it doesn't just come down to the data. It also comes down to the outlook. So sentiment will be absolutely key. So here's a breakdown in terms of some of the big names. Do you know what? I'm going to go full screen. As great as my head is, then we can see absolutely everything here. So what are we looking out for? So this first and foremost is actually Q1. So this is, did we see sectors outperform, underperform against expectations? Well, you can see here the strength really coming from communication services, information technology. So some of those tech names, utilities did particularly well as well. Consumer discretionary as well. And on the bottom end, it feels like energy has been a sort of sob story for some time yet. You can see underperforming or weakness as is expected, but actually slightly less than had been anticipated. Healthcare, the big loser, really significant downside in terms of earnings growth, much more than was actually the case or expected to be the case. And materials, again, weakness, but that was largely expected. So what's different this time around? So here's the Q2 outlook. So first and foremost, let's just look back at the S&P 500 in its entirety. So you can see 5.9% we saw in terms of earnings per share growth. That's over and above the 3.4 expected. So outperformance. So 5.9 is what we saw this time around. What we expected, 8.8 expected here for the S&P 500 as a whole. That's actually down from what had been predicted at the back end of March. So perhaps the fact that we've outperformed on Q1, people are sort of tempering their expectations somewhat for Q2, thinking that earnings growth might come in a little bit slower, but still very strong growth expected for the second quarter. In terms of areas that look particularly interesting. So remember previously we had communication services up top and we had information technology in third. That still remains the same. This time around, look at where energy's gone. Energy's gone from bottom of the stack, and that has been the case for recent quarters, and now fourth highest. So we're seeing this potential big turnaround story for the energy sector within this earnings season. And certainly, despite the fact that, some prices within energy have sort of seen some jitters over recent months, we have got the expectation that things are really going to take a positive turn here for the energy sector. Materials continuing to be a bit of a sob story at the bottom end of this. In terms of revenues, by and large, you can see that revenue growth positive pretty much across the board apart from materials. The expectation here is that the tech names going to do well at the top end. Energy going to see a strong boom in terms of revenues. Big upgrade in terms of that compared to where we were back at the 31st of March. You can see 9% expectations of revenue growth up from 3.6%. And then communication services, again, around the top end there. In terms of the S&P 500, roughly in line of where it was at the back end of March, so not a huge amount of change there, but 4.6% expected on that second quarter revenue growth year-on-year figure. So this is always an interesting one, right? So there's always a lot made out of the fact that the UK market is heavily geared towards international revenues, right? So let's say if the pound falls, then you can say, well, those companies that are earning abroad, all of a sudden their earnings have increased in value and therefore it should benefit them when they're reporting. And that's why you can often see, say, if cable declines, you might see the FTSE 100 moving towards the upside. So you have this inverse correlation. Well, how do things stack up from a sector on sector basis in terms of where these US businesses are essentially getting their money from, right? And some companies like utilities, it's just all the US really, and that goes for a number of different areas: real estate, financials, consumer discretionaries. We're sort of steadily getting there. And then you have the sort of tech side of things, which is a very close split, 57 to 43, and materials, communication services, that same kind of area. So we've got a very close split on that side of things. It is just materials and information technology, which earn more money from the international revenue than the US. Now, certainly what's interesting out of that is that if we look at this chart, and I just want to get rid of the disclaimer for a mere second. As you can see here, we've got the growth rate, the earnings growth rate for those companies in the first quarter with revenues below 50% in the US, so they're earning predominantly from abroad. They're seeing greater earnings growth. Now, part of this can be attributed to the fact that that's heavily geared towards the tech sector, but certainly those businesses that have an international focus appear to be doing particularly well in the first quarter. Next, I wanted to look at the guidance. So remember, when you see these companies report, you could say, has it beat on earnings? Has it beat on revenues? Okay, they could beat on both. And then when the company actually comes out, when the market opens, the stock can fall, and you can wonder why. Well, part of it will come down to the sentiment and the outlook from the CEO and the board members. And if the company are enjoying a good quarter, but the expectation is that they're going to have a difficult year ahead, you might see the stock fall despite the strength that they've seen for that quarter. So what's important is knowing that not only are things looking good right now, but things are expected to look good going forward. So this is the number of S&P 500 companies with positive or negative guidance for the second quarter. You can see in terms of the left-hand section, there's a greater focus on negative guidance than there is positive. The IT side of things, more of a close bet, 22 to 23. But certainly industrials, consumer discretionary, healthcare, consumer staples, materials, all have got a heavier weighting towards those CEOs that are coming out with negative guidance. And of course, that comes off the back of a year where people were coming into this year thinking we were going to see a massive boom in terms of economic growth as central banks start to cut interest rates. Well, 7 rate cuts this year have been trimmed down to 5, 4, 3, 2. Now the Federal Reserve pointing towards 1 rate cut. Market's still holding on to the idea that we might see 2. But so that sort of economic boom that has been expected over the course of this year, it feels like it's been delayed. And therefore, a lot of the CEOs will have been banking on that, so to speak. And it's not come to fruition. So they're coming out with a little bit more of a cautious outlook, which is why you're seeing a greater gearing towards the sort of cautious side of things. Because until we see the central banks coming and starting to lower interest rates, you're having to see a more protracted period where they're putting a squeeze on the economy. And that has potentially a detrimental knock-on impact on, say, consumer spending and the like. That's why you're seeing consumer discretionary and staples both seeing negative guidance on that side because we're starting to see some cracks appear within the US economic story. And that's because the Federal Reserve keep waiting to see inflation driven down to the point where they can start becoming accommodative once again. And we're not quite there yet. And then this is analyst guidance. It depends whether you care about this or not. Some people will see, this analysts come out with a price target 50% higher than where we are at the moment and things like that. And they'll think, brilliant, I want to buy the stock. And some people think that it's nonsense and they don't care about that whatsoever. But certainly it's notable from a sort of sector specific breakdown to see particular strength for the likes of energy here. The flip side of it is consumer staples. We're seeing less positivity on that side. There's a part of it that will also come down to the strength of these stocks already. So, of course, you'll know that if an analyst comes out with guidance and a target price, if that company then ramps up its share price to that target price, it can quite easily turn from a buy into a neutral or into a sell just based on that strength. So those sectors that have been underappreciated and hit hard and we haven't seen them really run up are probably more likely to see those price targets, if they're positive, remaining in play, and therefore it would show up within this chart as being an area that might look relatively attractive. Financials, 50% on the buy side of things, just 6%. You can see there's not many that are attributing sell side ratings, but certainly financials will be interesting coming into this first week. Sector level bottom up targets versus closing price. So again, if you're sort of totaling up what these companies are supposed to be worth, and you compare that to where the price is at the moment, you're pointing towards potential 16% upside for energy. So supposedly energy is the most undervalued of the lot. Tech on the flip side is the most overvalued, which is, of course, not surprising. It's very difficult for us to really value future revenues in an area like AI, which of course everyone's going crazy about and thinking that you're going to be able to have huge future profits from. Well, we don't quite know exactly how that's going to shake out. And so, it's no surprise to see that information technology, communication services, the sort of tech side of things on the bottom end of the spectrum. You can see materials, again, towards the upside. So you're talking about an area where between energy and materials, it's a lot easier for you to value all of the sort of constituent parts and give a price target that might be perceived to be higher than where current price is at the moment. Similar kind of thing with industrials, real estate. But as you get towards the bottom end of the list, a lot of this, in terms of tech, is coming down to sort of non-physical goods that can be a little bit more difficult to price. So it doesn't necessarily mean, tech's suddenly going to crash because people think it's worthless. It's not true. It's just that you're talking about future profits based on products that might not have even been created yet. And a lot of the time, people are essentially valuing these companies knowing that they're going to continue to innovate, which is very different compared to these very traditional businesses that might be physical in nature. And so their ability to ramp up production or create a new product is highly limited compared to the tech sector. Then looking at financials, this is where we start getting into what's coming in for the week ahead. So the S&P 500 financials, we're looking for earnings growth to be, according to this, around 4.3% on Q2. But what's notable out of this is this potential ramp up in terms of earnings at the back end of this year. So, still expecting some strong growth this quarter, but looking ahead, there is a view that we will see a significant upside at the back end of the year as we see potentially interest rates cut, people then taking on a lot more of a positive outlook when it comes to borrowing, when it comes to investing and spending, and therefore, the back end of the year is probably expected to be a peak in particular. Now, there's always a breakdown to be had because within the financial industry, you can see here that generally it is the insurance area that has been looking great of late. And then you can see that actually the banks are not necessarily looking too great in comparison to that. So will be very interesting to see exactly how things lead in. Given the fact that things kick off with the big banks, we don't necessarily want to see these big banks come out and see negative numbers that could really spark concern within markets, given the fact that they're starting earnings season. But very notable. Keep an eye out for, if people say, "Oh, I'm into the financials," insurance actually has historically been, or recently been, the real sort of area to look for because it's been reliably growing of late and having a really good time of it. So let me just get into a few charts and we can close things out on this. So first and foremost, this is JP Morgan Chase due to report on the 12th. So this is on Friday. Here's the outlook in terms of annual earnings per share. You can see the annual figure is not necessarily expected to rise massively over the course of 2024 and 2025, things ramping up into the sort of further future, 2027 in particular, up to 19.94. On the quarterly basis, we can see here a decline down to 4.13 from 4.44 is expected this time around. So, I wouldn't necessarily say this is super inspiring, but if we're looking at the past performance versus expectations, you can see apart from that Q4 2023 figure, you can see they reliably outperform on the earnings side of things. And then if we're looking on the revenue side of things, a similar kind of thing, generally outperforming on revenues and earnings apart from that Q4 2023. So, I guess, like I said, you can also talk about their outlook going forward and that they might be a little bit more concerned or, things like that. What's the guidance going to look like? But in terms of earnings, whilst it doesn't look that impressive in terms of the projection, arguably you could just say they're just setting themselves up for a period of outperformance. So here is the chart from the daily chart from JP Morgan. What's notable here? So first and foremost, we can look back at previous earnings reports, right? So you can see here we saw the sharp decline in after the earnings figure here on the 12th of April, and that provided a buying opportunity for a stock that has been a real reliable performer. And then we look back at the case prior to that, you can see January 2024, again, a sharp decline, and then we started to regain ground, and soon enough we're back up through that prior high. What we've seen recently has been a strong run up for this stock. So there is a possibility of a bit of profit taken. And certainly there is a possibility that we could see again, depending on how the earnings come out, of course, a sharp decline. But unless we see a breakdown through this prior swing low that we have here, 191, then if we see something similar to this, we can look back at prior occasions and say, well, generally these stocks or this stock has managed to recover and push up through the prior high. So pullbacks would be deemed a retracement unless we see that 191 level broken for JP Morgan. In terms of Citigroup, we can see here on an annual basis, earnings per share really dropping off over recent years, but the expectation is that we're going to see a strong recovery in the coming years. 5.74 expected for the year, but on a quarterly basis, you can see here 141, a decline down from 158. On the annual basis, you're looking from 133 to 141. So a year-on-year basis, you're looking for improvement. And if we're looking again at outperformance or underperformance, heavy outperformance again, apart from that Q4 2023 mark. And if we're looking at the revenues figure, how are things shaping up there? A similar kind of thing. So generally, they managed to outperform expectations apart from that one quarter. And so the outlook here is 141 on earnings per share, 20.09 billion on revenues. In terms of the chart itself, this is the daily time frame. We can see from a long-term perspective, we have been sort of recovering following that dramatic decline over the course of 2021, 2022, of course, and the COVID pandemic. We've now seen this strong run up to 65 resistance here that you can see that we've sort of tagged that, fallen away. We're back at this level once again. Let's look at how things shaped up previously in terms of earnings. So here was an earnings report here on the 12th of April. We can see here that was in the midst of a bit of a pullback, and we saw a sharp decline. We didn't break down through the price swing low once again, which on this occasion is down here, 56.45. And we ultimately rallied up and up and up and broke through resistance. We've been sort of consolidating ever since then. So it's worthwhile noting the ability or inability to break the 65 level, because it's not like we're seeing the same kind of trajectory as JP Morgan, where we're seeing it pushing up into new highs and new highs. On this occasion, we're sort of new highs, and then we're sort of seemingly in a bit more of a sort of consolidation mode here. But the bottom end, we continue to create these higher lows. And so these swing lows are really important. As long as we continue to make these sort of stepped moves towards the upside and we don't break the price swing low, then near-term weakness looks like a potential buying opportunity for the bulls to get into a trend that has been reliably moving towards the upside. So yeah, previous occasions we saw a bit of weakness here. On this occasion, we again saw a bit of weakness, but they didn't last too long. They last arguably about a week, maybe less, until we saw the bulls coming back into play once again. So as long as we remain above the 58.66, you know, any near-term downside, if we did see a pullback around this earnings report, probably likely to be treated in a similar manner. And then finally, I just wanted to shift topic a little bit away from the financials. This occasion is Delta Airlines. Delta Airlines, of course, you know, we're talking about a sector that was absolutely decimated over the course of the pandemic. And the question mark is, you know, will they recover? Well, a lot of these companies have taken on huge debt to try and stay alive and issued a lot of new shares. So I don't think they're going to necessarily all get back to where they were pre-pandemic. But what's notable here is that we have this sort of ramp up in expected profitability going forward. This is the annualized figure or annual figure. And again, revenues expected to gradually move towards the upside. In terms of the quarterly numbers, we're expecting to see a bumper figure of 236 this time around. If you look at previous occasions, you can see we also saw a very strong Q2 figure, 268. So this very much highlights seasonal basis moves as you're having summer trade essentially, and people are starting to travel once again. So Q1, generally you see weak numbers, you know, 0.25, 0.45. Q2, you're seeing the likes of 268, this time 236. That would be a decline on a year-on-year basis. maybe we see outperformance. We have done on the past 4 occasions. Prior to that, things were a little bit more jittery. But certainly recently, we have seen some nice outperformance over the course of the past 4 quarters. And then on the revenue side of things, a little bit more changeable in terms of outperformance. Sometimes we do, sometimes we don't. But arguably, I'd say that profits are probably going to be more important, as these businesses really need to be able to regain some of those losses that it saw over the course of the pandemic. In terms of the share price, this is the weekly time frame. So we can see here pulling back of late following a really strong run up at the back end of last year coming into this year. And you see this peak that we saw in May. We're starting to roll over since then. The daily time frame should give us an insight into how things have been treated around earnings. So we can see here earnings report. We didn't see a huge amount of movement, and we ultimately moved higher. And this time we saw this sharp decline with that pullback soon enough providing a sort of buying opportunities, and the bulls came back into play. And it was this earnings report here that we saw a further decline, but ultimately the market bottomed out in the same month of October. So we're falling much like in October there. Will we see this earnings report providing the basis for another strong move towards the upside? Well, you can see here in terms of sort of swing lows, I would say this cluster here, you can see this area here, that would probably be the area of consolidation where we then moved on to the next leg higher. So 45.45 I would say is the near-term key support level to be looking out for. If we break below that level, then maybe we start seeing further downside. But given the gains that we have been seeing at the back end of last year coming into this year, hopefully we'll see this stock start to rise once again. We'd need to see a breakout from this intraday trend of lower highs in particular. So we'd be looking for a move through 48.64 to give us some confidence that this pullback is over. But certainly, given some question marks around the US economy at the moment, I think it'll be very interesting to understand what this business thinks going forward, because bear in mind, we're talking about within the consumer discretionary, consumer staples area, we're talking about the idea that people are trimming back on items that they maybe don't deem necessary, and they're ramping up, or they're maintaining purchases of goods that they deem necessary, let's say staples, right? And as inflation rises, they can trim back on the unnecessary parts. Well, many people would deem a holiday as being the kind of thing they could trim back on. And so the outlook going forward for Delta Airlines is going to be very key, not only for airlines, but also for the consumer discretionary area, as we try to understand the perception of consumer spending habits given the current environment in the US at the moment. I hope all of that was useful. It's going to be an interesting time as we move through earnings season. In particular, everyone's going to be looking out for the tech sector, because at some point this massive ramp up in earnings is going to have to start to slow. And the question mark here is, what's the market going to do when that happens? And suddenly you start to see them reconfigure away from this idea that we're going to see huge growth and soon enough we see that slowdown. That could be a potential significant headwind for the markets. We don't necessarily know when that's going to happen. It could happen this quarter, it could happen next year, who knows? But when we do see that, that is a significant hurdle for markets to overcome, as we have to see them essentially, if they want to maintain the upwards trajectory for equity markets, they'd have to start really pouring money into some of these other sectors, as we likely see the tech sector cooling off. So plenty to sink our teeth into. For this week, it's going to be JP Morgan, Citigroup, and Delta Airlines. But we'll be bringing you weekly coverage, giving you previews for some of the key earnings for the week ahead, alongside the economic week ahead as well, which will be going out on a weekly basis and has been doing so. Make sure to like and subscribe the video. Thanks for watching. My name's Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day and a great weekend.